We will be discussing earnings, news, and economic data in this video lesson. The reason why we are tackling all three of these at once is due to the similarities they share regarding the effect on price action. Each of these events can cause large increases in volume and volatility as stocks quickly and violently adjust to the new wave of information created by them. Therefore, when trading stocks directly affected by earnings, news, or economic data, it is critical to use caution and discipline due to the sudden and often unexpected gaps in price that can occur. With each of these events, the following characteristics can be expected. 1. A considerably large trading range. Basically, the distance between the highest and lowest point the stock traded at during the trading day is much larger during one of these events compared to that of any other day. 2. Wider than normal spreads. In other words, the difference between the best bid and best offer available are commonly further apart during one of these events. 3. Much quicker prints, which means the speed in which buyers and sellers come in to execute trades occurs at a much faster pace during one of these events due to the substantial increase in volatility. And 4. Significantly greater volume. This means the trading volume on the day during one of these events is often 2, 3, even 4 times greater than normal. When seeking information on these events, speed and reliability are without question the most important factors to consider, as this information is only valuable immediately after its release to the public as price adjusts quickly. While there are many different ways this new information can be first released, the most common and reliable are through financial news feeds such as Bloomberg, CNBC, and Reuters. Let's take a look at each of these events separately and identify ways to successfully participate in them. First, let's discuss earnings. The earnings season is typically a time when the stock market as a whole has its greatest volume and range. These seasons occur quarterly, with the majority of stocks reporting 4 times a year. Typically, the most active earning months are January, April, July, and October. However, an earnings season actually takes about 2 full months for all of the stocks to actually report. Each earnings season is historically said to kick off when Alcoa, ticker symbol AA, reports its earnings. As a trader, you should always be aware of what stocks are reporting earnings for that day or even for the week for that matter, as such information will have relevance not only in the stock with earnings, but also in the entire sector in which the stock resides in. With an earnings calendar, you can identify the scheduled dates and times of company earnings announcements. This information can easily be found all over the internet on numerous free sites, such as Yahoo Finance. Now, stocks report Monday through Friday, typically before the market opens or after the market closes. Rarely will you find a stock report during market hours, especially with the larger cap companies. When stocks have earnings before the open, it means that the earnings will affect the price action in the stock that trading day. However, when stocks report earnings after the close, it then means that the earnings will affect the price action in the stock the following trading day. While some trades do take place immediately after the earnings are announced, both before and after market hours, it is a very small portion of total volume, as lack of liquidity hinders trading activity while the market is closed. Therefore, once the stock officially opens, a wave of orders flood in, causing violent moves in either direction as traders and investors buy, sell, and short based on the earnings. Because of this, it is important to use caution and discipline when trading an earnings stock, as the first 15 to 30 minutes are often filled with dramatic shifts in price. Let's take a look at the trading activity of stocks that have reported earnings to get a better idea of some of the immense moves that can occur. From this chart, we see State Street, ticker symbol STT, down over 16 points on extremely negative earnings and weak quarterly forecasts. While the amount of this gap in price is very uncommon, the gap itself is something that frequently occurs when a stock reports earnings. A gap occurs when a flood of buy or sell orders come in predominantly in one direction, requesting to be filled immediately once the stock opens. For instance, using this chart, we can derive that a significant amount of sell orders came in, thus creating a substantial gap in price due to the lack in demand, as no logical buyer would step in and purchase the stock at the current level when he or she knew a much cheaper price could be received. Notice the exceptionally large volume during the open in this stock because of the negative earnings. So how can you find out where a stock will open before it actually does? Well, while there is no way to find out exactly where a stock will open, you can typically figure out a general area where a stock is going to open by taking a look at the price action on the level 2 during pre-market hours. If there are ECN orders on the bid side above the previous day's closing price, then the stock will most likely move up and open up at least at the price displayed by the highest bid. Inversely, if there are ECN orders on the offer side below the previous day's closing price, then the stock will most likely open down, at least at the price displayed by the lowest offer. Moving on to the next stock, we see Long Top Financial Technologies, ticker symbol LFT, up almost 10% on the day on positive earnings. Unlike in the previous example, this stock did not gap up in price at the open and instead made a steady surge upward, rising the price at one point over $3 on the day. Keep in mind that while the moves on the chart may look relatively harmless, it is common to see a stock such as this one make pops and drops of 50 cents to a point in less than a minute, especially during the first hour of the trading day. Therefore, always stick to your exits when participating in earnings stocks. Furthermore, a common characteristic of a stock with earnings is an increased amount of volume. Take a look at how this stock has done over double its average daily volume by 2 p.m. This increase in volume due to earnings typically causes volatility as large buyers and sellers push the stock to a wider than normal trading range for the day. Okay, let's discuss how news can severely affect the price on a stock. News such as court decisions on company liability, CEO changes, takeover speculation, and upgrades and downgrades all instantly impact stocks upon release. Such news can be released at any time during the trading day and usually causes sharp moves in price as volume dramatically increases. Keep in mind, the importance of a particular news announcement diminishes as time passes. Therefore, consider how long the information has been available to the public before trading. It is very common to see a stock suddenly surge or drop in price on a particular news announcement, then make a few attempts to reverse or retrace the move that just occurred, before ultimately ending up somewhere in between the initial price the stock was at prior to the announcement and the furthest point of the move after the announcement. This is where price action typically ends up consolidating. Therefore, prior to entering a trade based on news, it is important to decide if the news has already been factored into the current price. Remember, sometimes not entering into the trade is the best move. If you are too late to the party, you run the risk of entering at the end of the move, just as everyone else is exiting. Let's take a look at an example of how quickly news can affect the price of a stock. This is a chart of the retailer Macy's, ticker symbol M. Now, during the middle of the trading day, around 1 p.m., Macy's publicly announced that they are going to cut 7,000 employees and decrease their dividends. This extremely negative news instantly dropped the stock price over $1.50 in roughly 15 minutes. Notice how the volume immediately increased following the announcement. This is very common when a stock releases news. Now, let's take a look at a few other retailers during that time when Macy's made the negative announcement. This is a chart of one of Macy's competitors, JCPenney's, ticker symbol JCP. Notice how this stock also fell substantially, almost immediately after Macy's released the bad news. This is because of the assumption that was drawn that tough times for Macy's means that tough times for their fellow competitors are also ahead. Because of this, JCPenney's made a similar downward move, decreasing about 1 point. This next chart is another retail competitor, Kohl's, ticker symbol KSS. Just like with JCPenney's, Kohl's falls about 1 point, simply based on its association with its fellow retailer, Macy's. And in this last chart, we see another competitor, Nordstrom, ticker symbol JWN, which managed to fall only half the distance of its counterpart, Macy's. Nordstrom fell 75 cents before making a serious attempt at a reversal. From these retail stock charts, we can see that while each made a sharp down move immediately after the negative news was released, and each subsequently bounced back up to some degree, every one of these stocks did so in a slightly different manner. This highlights a point that we discussed in the previous video lesson on trading sectors. It is often smarter to seek out and trade a different stock in the same sector as the one that made the announcement. This is because other stocks in the same sector will lag the stock with the news on it, thus enabling you to use it as an indicator of direction. Okay, the last topic we will discuss is economic data. When economic data is released to the public, it often has a large impact on the general trend of the market. Positive or negative economic reports can influence any and all stocks in the stock market. Therefore, you should always be aware of what economic data is being released each day and at what time. In a few moments, we will discuss the most prominent economic data that affects traders. For the extensive list describing all of the reports and surveys that affect price action, review the written lesson found in the classes section. Okay, with economic data, a majority of it is actually released pre-market. Such key data includes reports like business inventories, factory orders, durable goods, and the unemployment rate, just to name a few. These economic numbers are usually disseminated at 8:30 a.m. and have a major effect on the opening price of the overall market. You will find that if the economic numbers are less than what was expected by the general consensus, then the market will most likely open lower, and as a result, the majority of stocks within it will open lower because of it. But if the numbers are greater than expected, the market, as well as the majority of stocks within it, will open higher. Since the adjustment in price is made on the opening print, economic data released pre-market has more to do with setting the overall market trend in the morning than actually creating a particular trading setup. It is important to note that with just about all types of economic data, past performance is used as a comparison to current performance to help draw an opinion on the overall success or letdown of the report. Therefore, when looking at economic data, it is important to see the prior session's numbers next to the newest set of economic data being released. Now, there are a few reports that actually come out during market hours, which in turn does create some ideal trading setups as price quickly shifts due to the new information being released. Some of these economic reports include the University of Michigan Consumer Sentiment Index, the Consumer Confidence Index, new home sales, and existing home sales. With each of these economic reports, an estimate or past data is given a day or two in advance prior to the actual number being released. Typically, a number higher than the estimate is a positive indicator, which in turn causes stocks to rise, while a number lower than the estimate is generally seen as a negative indicator, causing stocks to fall. Major surprises in these types of economic reports can cause moves in the overall market. However, it is much more common to see and expect major moves in stocks specifically related to that data. For instance, while reports such as new home sales can move the entire market, the more dramatic move commonly occurs on stocks within the home building sector, such as Toll Brothers and Pulte Homes. Now, there are two popular economic reports that actually go against the grain of thinking. In regards to stock price, lower economic numbers are actually better than higher economic numbers. These reports are the Department of Energy Oil Inventory and the EIA Natural Gas Storage Change. This is because oil and natural gas are commodities. If there is less supply than we demand, then the price will go up. And inversely, if there is more of it than we want or need, then the price will go down. Since energy stocks such as Chevron and Halliburton have so much oil and gas in their possession every single day, the value of a company shifts when the price of oil or gas dramatically increases or decreases, which in turn causes their stock to appreciate or depreciate in value. To help get a better understanding of this economic data, let's take a look at an example of a past announcement of oil numbers. In this slide, we see a screenshot of a Bloomberg terminal detailing the Department of Energy oil inventory numbers. While a Bloomberg terminal is probably the quickest way to obtain accurate information on economic reports, data from reports such as this one can be found all over the internet and TV. From this screenshot, we can see a bunch of oil and natural gas reports listed. With this long list of reports, there are 4 key ones to look at. These are the Department of Energy, often referred to as DOE, U.S. crude oil, gasoline, and distillate inventory reports, as well as the EIA Natural Gas Storage Change, which is located near the bottom of the list. Now, the majority of the time, the DOE reports the U.S. oil, gas, and distillate numbers on Wednesday at 10:30 a.m. However, they have been known to move the date and time around during holiday weeks, so make sure to always check the exact time the numbers are officially reported so that you are prepared. The EIA natural gas number, which too can be changed around, most often is reported at 10:30 a.m. on Thursdays. The Thursday natural gas number mainly affects natural gas stocks, such as Apache and Devon Energy, while the Wednesday DOE oil numbers primarily affect crude oil stocks such as Transocean and Schlumberger. However, since these two commodities are so closely related, stocks connected to either often make adjustments on both days. When analyzing this information, it is important to note that the survey number is released a few days in advance and provides a best guess as to where the actual numbers will report at. However, when the numbers are significantly off, like in this example, it can lead to some dramatic shifts in price for any stock related to energy, whether it's primarily an oil or natural gas stock. On Thursdays, a significant difference in the natural gas storage change would be anything greater than 10 units. Therefore, if the actual number reported is greater or less than 10 units from the survey number, then look to participate in an energy stock, as a quick and substantial move in price can be expected. However, if the number reported is less than 10 units away, or exactly even, then there is most likely no real trade off the announcement, as no major adjustment will take place. So for instance, using the surveyed EIA natural gas storage change number in this screenshot of a negative 174, we would plan on buying energy stocks should the actual number report negative 184 or worse, as this would imply that there's even more of a demand. And if the actual number reports negative 164 or better, then we would look to short energy stocks, as this would indicate some of the demand issue has been alleviated. Now, on Wednesdays, a significant difference is a little trickier to quantify, as there are three major numbers reporting: the DOE U.S. crude oil, gasoline, and distillate inventories. The general rule is that all three inventory reports should indicate the same thing, whether they all signal deficits or surpluses. That uniformity across all three reports eliminates doubt and gets all of the traders to head in one direction, creating some very profitable moves. Obviously, the bigger the discrepancies between the actual numbers compared to the survey creates that much more of a signal for correction. Typically, anything greater than 1,000 units is considered a major surprise in crude oil and gasoline inventories, while anything greater than a few hundred is considered a surprise in distillate inventories. Let's use the example in this screenshot in order to get a better idea of how price can dramatically change due to these economic reports. Near the top of the list of reports, we can see that the actual DOE U.S. crude oil inventories number was 6,100 units, when the survey was only 1,400 units, meaning that there was a surplus of 4,700 units. From the DOE U.S. gasoline inventories, we can see that it too had a major unexpected surplus, as 6,475 units was the actual number reported when only 1,800 units were expected, thus indicating a surplus of almost 4,600 units. The third important number, the DOE U.S. distillate inventory, also reported an unexpected surplus, as the actual was 290 units greater than the survey. With all of this information indicating that there was a major surplus of oil, gas, and distillate out there, a wave of selling and short pressure came in, as oil was now worth less than before. Now let's take a look at a few charts of energy stocks to see how they were affected by these reports. In this first chart, we see Hess, ticker symbol HES, immediately drop in price right at 10:30 a.m. once a surplus was reported in all three inventories. Notice the large volume spike as the stock fell over 1 point in just a few minutes, as the stock adjusted to the new information that was released. The next chart is of Marathon Oil, ticker symbol MRO. This stock, which is about half the price of Hess, only falls about 40 cents, as it is commonly in a smaller trading range than other larger oil stocks. From this next chart, we see Murphy Oil, ticker symbol MUR, suddenly drop through support at $44.40, dropping the stock about 60 cents on bearish oil numbers before attempting a reversal. In this next chart, we see Transocean, ticker symbol RIG, make a sharp move down about 50 cents. Unlike in the previous chart of Murphy Oil, Transocean barely made new lows on the day before bouncing. Moving on to VLO, also known as Valero Energy, we can see that a significant amount of trading activity took place during the quick drop of over 50 cents. In a 2-minute span from 10:30 to 10:32 a.m., 500,000 shares were traded as sellers pushed the stock down rapidly. And in the last chart, which is of ExxonMobil, ticker symbol XOM, we can see that the stock easily broke through lows once the surplus was reported, causing the stock to drop about 80 cents within just a few minutes. From these charts, it is easy to see how Wednesday and Thursday economic inventory numbers in oil and natural gas can cause significant moves quickly as price adjusts to the new information. Ultimately, when trading stocks based on earnings, news, or economic data, it is crucial to follow your preset guidelines, as the volatility in these stocks greatly increase during these events. Always follow a 3-to-1 reward to risk ratio and do not venture away from your game plan. The same type of setups you use every single trading day form during these events. Never enter or hold onto a trade simply because of the information being released. Do not create opinions solely on any one indicator, especially information such as earnings, news, or economic data, as the logical direction is not the direction the stock always heads in. Therefore, trade what you see, not what you feel. Use all of the indicators that you have developed as a disciplined, experienced trader to dictate what you will do next.